Welcome to The Explainer. Today, we're diving headfirst into a massive financial mystery. I'm talking about a data anomaly so extreme, it literally sent shockwaves through the entire global bond market. So imagine for a second that you're an institutional investor, right? Or a market analyst. You're staring at your terminal and suddenly you see a data point flash across the screen that is just so incredibly far out of the ordinary, it fundamentally alters your entire read on the global economy. Well, that is exactly what happened recently with a very closely watched set of fixed income fund flow data. But as we're about to see in the world of high finance, things are not always what they seem. We're going to unpack exactly what went down, how one single transaction managed to distort the entire market's view, and what this whole saga actually reveals about the extreme sensitivity of global capital right now.
Negative $7.1 billion. Just take a second and really process that number. According to data that was published for the week ending July 22nd, this was the reported net withdrawal from U.S. investment-grade bond funds. To put that into perspective, this wasn't just a bad week at the office. This looked like a historic, absolute exodus. And this massive headline figure was heavily driven by a jaw-dropping, record-breaking $8.2 billion one-day outflow that supposedly hit on July 20th. I mean, when a number like that hits the wire, the immediate assumption is that institutional investors are just slamming the panic button, yanking their capital out of high-quality U.S. corporate debt as fast as they can. It's exactly the kind of red alert signal that makes trading desks completely rip up and reevaluate their risk models.
But wait, here comes the ultimate whiplash plot twist. When the London Stock Exchange Group's Lipper unit, the guys who track this vital fund flow data, actually launched an investigation over the weekend, they realized something crazy. That massive withdrawal, it was entirely driven by one unusually large transaction in a single anomalous fund. When Lipper excluded that specific fund from their review, the dark clouds just instantly parted. The picture completely reversed. Instead of a catastrophic $7.1 billion outflow, the adjusted data showed that U.S. investment-grade funds actually took in about $1.54 billion in net inflows for that exact same week. So the sky, as it turned out, was not falling at all.
So where on earth did this massive distortion actually come from? Well, the investigation zeroed in on a sizable movement within one specific classification, which is short intermediate investment-grade debt. LSEG disclosed this review over a weekend, essentially scrambling through a super tight 32-hour window to figure out how one single classification could completely skew the narrative for all U.S. corporate debt. Now, the identity of the specific fund wasn't immediately made public, but just pinning down the location of the anomaly was the first major step in solving this mystery. It really highlighted just how heavily weighted certain funds can be within these broader market metrics, and how one isolated incident in the short intermediate space could essentially break the compass for everyone else.
The real crux of the issue here is understanding the true nature of that massive transaction. Lipper had to figure out, was this a genuine investor withdrawal, or was it what the industry calls an operational event? An operational event is essentially just a structural transfer of funds, or maybe some form of internal restructuring. Basically, it's administrative. It is not an actual investment decision, like panic selling or strategically redeploying capital to a different asset class. And that distinction, that is the absolute key to this entire mystery. If billions of dollars were just being shuffled between different corporate structures or accounts rather than actually fleeing the market, well then there was no broad deterioration in institutional demand. The capital wasn't actually leaving the ecosystem at all. It was just changing its clothes.
Now, you're probably asking yourself, why was the market so incredibly quick to believe the initial terrifying data? Like, why didn't everyone just immediately assume it was a glitch? Well, it's because the global fixed income markets were already navigating a really fragile environment. We're talking about higher treasury yields, widening credit spreads, renewed concerns about inflation, and constantly shifting expectations about what the Fed is going to do with interest rates. When the ecosystem is that sensitive and investors are already super anxious about rate risk, a $7.1 billion outflow doesn't look like a mistake. It looks like total confirmation of their worst fears. It perfectly fit the anxious narrative of the moment.
To understand that anxiety a little bit deeper, we just need to think about the mechanics of these bonds in the current climate. In an environment where government yields are rising, longer duration investment-grade securities naturally become incredibly vulnerable to benchmark shifts. So when the market saw what looked like massive selling pressure in investment-grade debt, it actually made total logical sense to observers. They just assumed investors were proactively dumping these rate-sensitive assets to manage their duration risk and basically get out of the Fed's way. It was a completely plausible reaction to a very real macroeconomic threat. And this perceived divergence briefly had the market completely fooled. While investment-grade debt looked like it was bleeding $7.1 billion,
Riskier assets were painting a totally different picture. High-yield bond funds actually attracted about $534 million during that same period. Leveraged loan funds, they recorded modest inflows too, proving pretty resilient. And honestly, this is exactly why the false data was so convincing. It painted a perfectly logical picture of capital rotation. It looked for all the world like institutional investors were just fleeing rate-sensitive safe debt and parking their money in higher-yielding and floating-rate instruments to protect themselves from inflation and rate hikes.
Which brings us to the broader implications here. The stark difference between a fake signal and a real signal. Because fund flow statistics, they aren't just trivia, right? They are the literal compass that investors, asset managers, and trading desks use to track global momentum. The fake signal told a story of an aggressive institutional retreat from investment-grade credit driven by overwhelming rate fears. But the real adjusted signal, that $1.54 billion inflow, tells a completely different story of continued positive capital allocation. It shows that institutional demand for high-quality corporate debt actually remained really resilient, even in a difficult, uncertain interest rate environment. That is a fundamentally different economic reality.
Let's ground all this highly technical fund flow jargon into real-world stakes, because why does this actually matter to us? A swing from a $7.1 billion withdrawal to a $1.54 billion inflow isn't just some spreadsheet typo. It directly impacts three critical pillars of finance. First, it dictates how the world interprets actual real-world demand for corporate bonds. Second, it helps assess the durability of credit market liquidity, which basically means how easily assets can be bought and sold without triggering massive price crashes. And third, and definitely most importantly for the broader economy, it determines the ability of everyday companies to actually access debt markets to fund their operations and growth. If that fake signal had been true, corporate borrowing costs could have absolutely skyrocketed.
So where does that leave us right now? Well, Lipper has officially removed the affected fund from its current weekly flow report. The message here is basically extreme caution. Data validation is in progress. They've made it clear that further information is only going to be provided once the precise nature of this massive transaction has been fully, publicly validated. So until that process is done, anyone looking at the apparent record withdrawal from U.S. investment-grade bond funds really needs to treat it with a massive grain of salt. It's a pretty powerful reminder of just how vital it is to distinguish genuine investor panic from large, behind-the-scenes operational housekeeping. Which leaves us with one final, really fascinating thought to wrap up this explainer. If that $1.54 billion adjusted inflow is officially confirmed, it proves that capital is still flowing into high-quality corporate debt despite all the current macroeconomic headwinds. But looking forward, we have to ask the big question. Can institutional demand for corporate debt continue to survive the ongoing pressure of higher treasury yields and monetary uncertainty? This data anomaly gave us a brief, terrifying glimpse of what a full-blown market panic could look like. But for now, the real numbers suggest resilience. It's a super interesting dynamic, and it's definitely one that anyone following the financial markets will be watching closely in the months to come. Thanks so much for joining me to unravel this missing billions mystery.